And so the quarters theory basically puts these price fluctuations in a systematic order, if you will. So let's take a look, for example, at the latest developments with the euro-dollar exchange rate from the perspective of the quarters theory. Here we have the euro-dollar exchange rate basically flattening, which is perfectly normal ahead of a very important economic news or any kind of event or announcement from a major central bank. This here is the period about a day or so ahead of the Fed's interest rate announcement, which was last Wednesday, November 3rd. And if you note, all of the price action here occurs around a very important major large quarter point, which is the $1.40 level. Of course, this is the price level, which I call major whole number and a major large quarter point in the quarters theory methodology, because it's such an important junction that marks the end of the previous 1,000 pip range between $1.30 and $1.40, and at the same time, it marks the beginning of a brand new 1,000 pip range between $1.40 and $1.50. Because of the importance of these major large quarter points, they tend to attract prices, and a lot of traders also call them the so-called psychological levels, obviously. So the euro-dollar pair, before the Fed's announcement, has made several attempts to move above $1.40 and make that transition into the $1.40s from the $1.30s. But it has been denied. It's been pushed back. And now, ahead of the Fed's announcement, we're seeing another attempt. These lines that you're seeing here, the dotted lines, are the previous resistance levels, by the way, which were around $1.41.5 or so, and then you have $1.40.80, an area between $1.40.50 and $1.40.80. There were a couple of resistance levels along the way. Every trader should also consider where prices, what type of a large quarter, which large quarter will prices be more likely to start working on. And I did a webinar, and on my AllThingsForex broadcast, I also discussed the two scenarios that we can anticipate and prepare for ahead of the Fed's interest rate announcement. The first one was what I call the shock and awe scenario, and the second scenario was the so-called measured approach scenario. The first shock and awe scenario was the Fed going with over $500 billion of additional quantitative easing and up to $1 trillion. Actually, if I'm not mistaken, Goldman Sachs was even forecasting more than $1 trillion, up to $2 trillion that the Fed might throw in. But the general perception was that if the Fed goes with a larger than $500 billion additional Treasury bond purchases, then that would be a more aggressive type of scenario than the opposite, which was the so-called measured approach, as Wall Street Journal called it, which would have been Treasury purchases of, let's say, $100 billion, which is definitely not that massive of an amount. So the two scenarios that we were prepared for is if the Fed goes with the shock and awe scenario, then the dollar weakens additionally, and this could possibly serve as a catalyst for the euro to challenge these resistance levels, $1.48 and $1.41.5 area, and then ultimately break above them. And if it breaks above them, then that creates an opportunity for what I call a completion of a large quarter or a large quarter move, which would start from the large quarter point at $1.40 and potentially target the large quarter point above $1.40, which is $1.4250. This is obviously a very important large quarter because it's the first large quarter of the new 1,000 pip range. And in the aftermath of the Fed's announcement, if you see this candle here, this is, by the way, a 60-minute chart of the euro-dollar pair. You can see the market's reaction. The euro spikes up, pulls back a little bit, but slowly but surely in the hours after that continues to grind higher, breaks decisively above these resistance levels, and it goes to do, surprise, surprise, a challenge of the large quarter point at $1.4250. Of course, when I say the word surprise, I'm being facetious because every currency trader who is familiar with my quarters theory would know that the next logical price point that the markets could target is the large quarter point at $1.4250, especially if decisive move above $1.40 happens and the euro-dollar pair breaks above $1.41 to 7 or 59 resistance level, which the euro-dollar pair did. And it reached the large quarter point at $1.4250. Moreover, it even made an attempt to work on the next large quarter of 250 pips, which would have been the quarter between $1.4250 and $1.45. But what I wanted to talk about today is how a trader could recognize some signs of what I call unsuccessful transition into a new large quarter. And a very helpful tool for that is a tool that I designed, and I call it the hesitation zone. The hesitation zone is the range of the first 75 pips, or 3 small quarters of 25 pips each. Because just as you can divide the 1,000 pip ranges into 4 equal parts, you can also divide the range of 100 pips between 2 whole numbers. For example, the 2 whole numbers between $1.40 and $1.41, or $1.42 and $1.43. Those 100 pip ranges, we all use the decimal numeral system obviously, can be divided into 4 equal parts, or 4 what I call small quarters of 25 pips. And it's very important for a trader who utilizes the quarters theory methodologies to pay attention to price behavior when prices attempt to enter a new large quarter. Because the first area that they enter is the area of 3 small quarters of 75 pips above or below a large quarter point, which I call the hesitation zone. And the name should say it all. Prices do often hesitate within that area.